Hi traders, you are welcome to my video on one of the most underrated tools in trading, and that is the imbalance locator. Okay, so if you have ever wondered why price moves the way it does or how to spot hidden opportunities in the market, then this video is for you. By the end of this video, you will know exactly how to identify market imbalances, interpret them like a pro, and use them in your trading strategy. So make sure to stick around, and if you are new here, don't forget to smash that like button and subscribe to the channel so you never miss valuable trading content. Okay, now let us get into it. All right, so let us start with the basics. Yeah, what is an imbalance locator? The imbalance locator, or the imbalance detector, is a tool that helps traders spot areas where buying and selling pressure is uneven. You can see how the imbalance locator have identified areas where there were imbalances, where there was uneven pressure between buyers and sellers. Right here on the chart, you can see I already added the indicator to the chart, and it has already automatically identified those important areas. So these imbalances happen when one side of the market, either buyers or sellers, takes control, leaving behind inefficiencies in price action. Okay? So think of it this way. When institutions or large traders place massive orders, they don't always get filled instantly. So this creates an imbalance where price moves aggressively in one direction before returning to fill those gaps. These areas become key levels that can offer high probability trade setups. Okay, this concept applies to Forex, stocks, and even crypto, making it a powerful addition to any trader's toolkit. All right, so how do you identify these imbalances? One of the easiest ways is by looking at large aggressive moves in price, especially long bullish or bearish candles. All right, these often signal strong buying or selling pressure, leaving behind unfilled orders. Okay, now another method is using order flow tools or volume profile indicators to see where liquidity is missing. These areas of low volume trading often indicate an imbalance that price may revisit. You can also use smart money concepts, focusing on liquidity zones where institutions tend to enter and exit trades. When you combine these techniques, you start to see patterns that most retail traders completely overlook. Now, let us talk about how to trade market imbalances. Okay, the first strategy is the imbalance refill trade. All right, the imbalance refill trade. When price leaves an imbalance behind, when price leaves an imbalance behind, there is a high chance it will return to fill that gap before continuing its trend. So you mark out the imbalance zone and wait for a price retracement. You can see example here. Look at this imbalance zone. You can see that price eventually came back down. Can you see that at this point price got to this high, and after getting to that high there was an imbalance zone here. You can see how this candle was. There was an imbalance zone here, right? So price eventually came down back, although it didn't fill the imbalance completely, but at least it got to, you know over 50% of that, imbalance. Right, you can see this particular level where it got to. Then look at You can see another imbalance zone that was identified. In fact, we can see that we had a couple of imbalance zones identified here. Now, just fast forward to some, was it 2 days later, you can see that this whole, imbalance got filled up as the price came back to this point and filled these whole imbalance zones. All right. So that is the first strategy, the imbalance refill. Okay. You want to look for confirmation signals like candlestick patterns or support and resistance before entering. Okay. The second strategy is the continuation trade, because sometimes price doesn't return immediately and instead continues in the direction of the imbalance. So in that kind of situation, you can use these imbalances as trend confirmation. All right. You can use those imbalances as trend confirmation. If price is forming multiple imbalances in one direction, it often signals strong momentum. Okay. Like in this particular scenario, there was actually strong momentum, even though eventually the imbalance got filled. But this was showing that there was actually some strong momentum, right? And you can see this other example. This is a bullish example showing that there was actually some strong momentum. Now, these setups can be used on multiple time frames, whether you are scalping, day trading, or even swing trading. At this point, you might be wondering, how do I actually use this in my trading? Here's how. First of all, pair imbalances with technical analysis. All right. Look for confluence with key levels like support and resistance, Fibonacci retracements or trend lines. Second, use imbalances to confirm your trade entries. All right. Use imbalances to confirm your trade entries. If you see an imbalance aligning with your setup, it adds extra confidence. Lastly, track them across different time frames. Higher time frame imbalances act as major price magnets, while lower time frame imbalances will help with precise entries. When you notice an imbalance on a higher time frame, it's a major price magnet. You can actually find very good opportunities, but when you want to look for precise entries, you can then go to lower time frames. Okay. When you start integrating this into your strategy, you'll be able to see, market's hidden structure in a whole new way. All right. So if you found this video helpful, make sure to hit that like button and subscribe for more powerful trading insights. Okay. Let me know in the comments, do you use an imbalance locator in your trading? Or do you prefer other tools like order blocks and liquidity zones? Let us discuss it below. In the meantime, thank you for watching and I'll catch you in the next one. Happy trading.